So I've been investing for over a year now using Wealthsimple Trade, and I feel I've gotten pretty good at it. Although the investing environment that we're currently in is constantly changing. When I started, interest rates were low, they're going up. Inflation, yeah, it was kind of there, but it too is going up on a monthly basis. So the world is changing, and our investing strategies need to change with it. And with that, I'm looking for a few things. I want to keep as much of my money in my wallet, in my account. I want to maximize profits like all of us. I want as much money coming back in. And for me, I like to kind of mitigate risk. And you might be in the same boat, just kind of, I'm new to investing. I really don't want to put myself out there too much. And I want to kind of control some risk. So I'm looking for something that is a safe, proven method. And that's what ETFs are. Exchange traded funds are pretty much can meet all those criteria. And I'm going to talk about 3 different ETFs that are paying a high dividend yield, have a low management expense ratio. And because there's a wide variety of stocks that it's putting its money into, you have that diversification that offers you up some of that protection. But they're not all the same. So we're going to go over that. So let's get on with the show. Hey, I hope you and your investments are doing well. My name is Steve, and I am a dividend stock investor. I am putting $150 every week into my tax-free savings account and documenting my journey as I grow it this year to be over $20,000. And my ultimate goal was after 5 years, up to $50,000. But of course, we're not going to stop there. We're going to grow this thing as fast as possible. And part of that strategy is investing in quality stocks and using quality strategies. And one of those strategies would be using exchange traded funds, ETFs. Just before we jump into the content, I want to know from you if you love ETFs as much as I do. Just write "I love ETFs" in the comments and let me know. It's just a little survey I'm doing. So I love ETFs in the comments if you are already on board with this great investing strategy. So let's talk about 3 different high dividend yield ETFs that will help grow you money and help you sleep at night since you don't have to worry. Okay, so the 3 ETFs that we're going to look at are ZDV, XEI, and VDY. There's a mouthful of acronyms there for you. Okay, so the first one we're going to look at is the BMO's High Canadian Dividend ETF. All right, so this ETF is designed to give you exposure to a yield-weighted portfolio of Canadian dividend-paying stocks. The stock price is currently around $22. Its management expense ratio is 0.39%, and its annualized dividend distribution yield is around 3.84%. So the fund is designed for investors looking for income and growth solutions, exposure to higher dividend-paying Canadian equities, and sustainable income with lower volatility than the market. And so the lower volatility than the market, we can take a look at that here. When we look at, say, the 1 year over year, this stock is it's up 21%. So that's great. I like to always look then what's, say, in this ETF, especially if I already holding some different Canadian companies. I want to make sure that I'm say, not holding too much of one particular one. So let's take a look at the holdings. And here we can see that they've got a whole list of them. Its total is 51 different holdings, and it's all in Canadian companies. Enbridge being the first one, making up 5.24%, followed by BCE, Royal Bank of Canada, Bank of Nova Scotia, Nutrien Limited, and thus forth. Here we can see the sector allocation. It's 39% in the financials, followed by energy, 15.46%, and utilities, 12.51%. You're going to see some themes here when it comes to the sector allocation. There's differences between the 3 different ETFs that we're going to be looking at today. Okay, next one we want to look at is XEI. Okay, so this is iShares S&P/TSX Composite High Dividend Index ETF. It's currently priced out around $28.86. And its whole thing is that it pays a monthly dividend income. Three of them pay monthly income. The numbers of holdings is 75. This is the greatest of the three ETFs that we're going to be looking at. Its distribution yield is currently 3.47%, and its management expense ratio is 0.22%. So it is definitely lower than the BMO ETF, but not that much lower. But 0.22%, that's fair. That's decent. Its top holdings are, by sector. That's what stands out the most to me, is primarily the top 5 out of the top 6 are energy, BCE being in there as well, communications, followed by Royal Bank of Canada, more communications, and then more finances. And here you can see the sector breakdown even further, where the energy makes up 30.95% of their portfolio, followed by financials, then communications, utilities, real estate, and thus far. So this one is made up more of the energy versus when we looked at the BMO one, where it was the financials being the top. And I'll just jump over there to kind of help us remember, 36% financials, where this one is 28.5. And let's look at the year-to-year performance of this stock. And it is currently up year over year, 27.79%. And again, I'll remind you that the S&P 500, which is usually the favorite benchmark, that is currently up around 6% year over year. And the last one we want to look at is Vanguard's ETF VDY. It is the Canadian High Dividend Yield ETF. It currently has a management expense ratio of 0.22%. So that's the same as the iShares one. So there's 2 pluses for those two versus BMO if you're looking for a lower management expense ratio. Its 3-month yield is around 3.36%. So they're all in that same range, off by say 0.2% or so. And let's look at its year over year. So it is up 25% year over year. So if you recall, here I can add all 3 of them to kind of compare, where we can see that iShares overall is currently outperforming, but they're all doing well. They're all doing over 20%, which I would never complain of a 20% increase in my portfolio. Never would. And once you add the dividends paid on top of that, you're winning. You are winning. So going back into Vanguard, we want to take a look at the holdings that they have. And here's the sector breakdown, where 57% are in the financial. So it is very, very high weighting on the financial sector, followed by energy, 26%. So just even between those 2 percentages, we're looking at you're at 83% overall is between financials and energy. So that's something you have to be comfortable with, because then after that, telecoms, utilities, it's all under 10% to round out the 100. So when I compare that to the other two, that becomes a question I have to ask myself, am I good with that? Where VDY is higher in the financials compared to the BMO. One with 36% compared to the iShares, which financials is 28%. Then the energy here is 30.95%, and here 26.3%. And then over here, energy and utilities are definitely a lower percentage here. For me then, when I'm looking at all 3 of these and trying to decide what one is actually going to be best for me overall, I'm looking at the management expense ratio. I do want to pick something that is lower than the competition. So in this case, that brings it down to the iShares and the Vanguard. I do look at the distribution yield, but I'm always picking something in that 4% range. If it's off a little bit from one another, then I'm okay with that. I might still pick one that has a slightly lower yield, especially if everything else, all the other check boxes get checked. And then one of those other boxes for me is the holdings that it has. I don't like that the iShare ones has more energy weighting than the others. For me, the Vanguard one more aligns with how and where I want to put my money. I don't want to put as much money into energy unless I'm specifically buying renewable energy companies, which in this case, you're not. You are buying oil and gas companies, you're buying pipeline companies, because those are high dividend paying companies. So I will then pick the ETF that has the lower concentration of those funds. Of course, these ETFs are just the tip of the iceberg. There are plenty more out there. Do your research, figure out what is the best fit for you. Are you okay with a higher management expense ratio because you're getting a higher dividend yield? Be mindful of the different type of ETFs. And I'm always weary when I see a yield that is too good to be true. I really want you to look into kind of why that is. There's content for a future video. Stick around, like, subscribe, and we'll make that content for you to kind of look at some of these split type strategies, covered calls. I've stayed away from those for the most part because I am a long-term investor and I'm not looking for a get rich quick scheme. So, and if you're young, guys, that is the path to take. You've got plenty of runway, okay? I'm in my 40s and I've been able to grow this pretty quickly. Okay, so you're younger, even if you're putting in like 100 or so, you're good. You're good. Don't try and do it quickly. I'm going off topic, but there are other options, other ETFs out there. Again, I did a video here that talks all about different bond ETFs if you're looking to kind of diversify your asset class. So check out that video and let me know what you think. That's it for this video. We'll see you in the next one, and keep it in the green. Bye.